put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. The $2 billion that never existed. In June 2020, auditors at Ernst & Young opened a manila folder in Munich that would shatter the backbone of European fintech. Inside were confirmation letters from 2 Philippine banks, routine documents verifying cash balances for a company called Wirecard. The numbers were staggering. 1.9 billion euros sitting in trust accounts, supposedly processing payments for merchants across Asia. But when EY's forensic team made a simple phone call to verify the accounts, the response came back cold and final. Those accounts don't exist. The money had never been there. Not last year, not ever. What auditors had stumbled upon wasn't just accounting fraud. It was a phantom empire, a digital mirage that had fooled regulators, seduced investors, and infiltrated the highest corridors of German power for nearly 2 decades. This is the story of how a payment processing company became a criminal enterprise, how 2 billion euros vanished into thin air, and how the dark machinery of financial deception operates when everyone chooses not to look too closely. The year is 1999, and Munich's tech scene is barely a whisper compared to Silicon Valley. A former management consultant named Marcus Braun takes control of a small company processing payments for online porn and gambling sites. The digital underworld that credit card companies won't touch. The company is called Wirecard, and it occupies the moral gray zone where legitimate finance meets the internet's shadiest corners. Braun sees opportunity in the darkness. While other payment processors distance themselves from adult entertainment and online betting, Wirecard embraces these clients, building relationships in places where questions aren't asked and cash flows through opaque channels. It's a business model built on processing transactions that exist in legal twilight, where high fees compensate for reputational risk and regulatory scrutiny is something to be managed, not welcomed. By the mid-2000s, Wirecard is expanding beyond its vice industry roots, targeting mainstream e-commerce merchants who need payment processing across borders. Braun positions the company as a fintech innovator, the European answer to PayPal, a digital payments revolution headquartered in suburban Munich. But beneath the respectable veneer, the original DNA remains. A comfort with opacity, a talent for operating in jurisdictions where oversight is minimal, and a corporate culture where aggressive accounting isn't a bug, but a feature. The transformation from payment processor to phantom empire begins with a simple but devastating strategy. Wirecard starts reporting explosive growth in Asian markets that can't be easily verified. Third-party acquirers in the Philippines, Singapore, and Dubai supposedly process billions in transactions on Wirecard's behalf, generating massive revenues and profits. These partners operate through complex networks of shell companies, their ownership structures deliberately obscured behind corporate veils in offshore jurisdictions. The brilliant criminal insight is this: European auditors can't easily verify transactions processed by third parties in distant countries with different regulatory regimes. Braun and his inner circle, Chief Operating Officer Jan Marsalek, a mysterious Austrian who cultivates connections with intelligence agencies, and Chief Financial Officer Burkhard Ley, create a parallel universe of fake transactions. Money appears to flow through Wirecard's systems, generating fees and profits that exist only on spreadsheets and forged bank statements. The Asian third-party business becomes Wirecard's golden goose, the source of profitability that justifies the company's soaring stock price. By 2018, Wirecard is valued at 24 billion euros, more than Deutsche Bank, Germany's flagship financial institution. It joins the DAX 30, the elite index of Germany's most important companies, a validation that opens institutional investment and cements respectability. But the entire Asian success story is fiction. Transactions that never happened, merchants that don't exist, cash balances conjured from nothing. The first cracks appear not from regulators or auditors, but from journalists who refuse to stop asking questions. In 2015, the Financial Times begins publishing investigations into Wirecard's accounting irregularities, suspicious transactions in Asia, and allegations of round-tripping, money being moved in circles to create the illusion of revenue. Reporter Dan McCrum becomes obsessed with the story, spending 5 years peeling back layers of corporate obfuscation. Each investigation reveals new shadows, forged contracts, suspicious emails, whistleblower accounts from former employees describing systematic fraud. But instead of triggering regulatory scrutiny, the exposés trigger something darker, a coordinated attack on the journalists themselves. Wirecard doesn't just deny the allegations. The company weaponizes Germany's financial regulator, BaFin, against the investigators. BaFin files criminal complaints against the Financial Times journalists, accusing them of market manipulation and colluding with short sellers to drive down Wirecard's stock price. It's an extraordinary move. A regulator meant to protect market integrity, instead protecting a fraudulent company from exposure. Germany's establishment rallies around Wirecard as a national technology champion, a rare European success story in the American-dominated world of digital payments. Politicians, bankers, and business leaders dismiss the allegations as anti-German bias, as Anglo-Saxon financial journalists trying to tear down a continental success. Even when KPMG conducts a special audit in 2019 and finds numerous red flags, missing documentation, suspicious transactions, uncooperative third parties, the firm stops short of definitively calling it fraud, citing lack of access to certain records. The ambiguity becomes cover, allowing Wirecard to dismiss concerns as inconclusive while the fraud continues to metastasize. But behind Wirecard's public defiance, the machine is starting to break down. Jan Marsalek, the COO who supposedly runs the Asian operations, is living a double life that reads like a spy thriller. He cultivates relationships with Russian intelligence services, travels on multiple passports, and maintains apartments across Europe under different identities. Marsalek isn't just committing corporate fraud. He's operating as some kind of freelance intelligence asset, attending meetings with shadowy figures in Moscow, offering Wirecard's payment data and technology to foreign governments. The company has become something more sinister than a simple accounting fraud. It's a vehicle for intelligence operations, money laundering, and international intrigue. In late 2019, as pressure from auditors intensifies, Marsalek begins preparing his escape. He establishes exit routes through Austria, Belarus, and Russia, moving cash into accounts controlled through proxies, arranging for safe houses and new identities. The third-party partners in Asia, who supposedly process Wirecard's transactions, start becoming uncooperative with auditors, refusing to provide documentation or allow inspections of their systems. Some of these partners turn out to be entirely fictitious. Names on incorporation documents, addresses that lead to empty offices, executives who don't respond to any form of contact. The auditors at Ernst & Young, who have signed off on Wirecard's accounts for over a decade, finally begin to realize they've been approving financial statements built on systematic deception. In early 2020, EY demands direct confirmation of the cash balances held in trust accounts by Wirecard's Asian partners, the 1.9 billion euros that supposedly secure merchant transactions. This is when the House of Cards enters its terminal collapse. Marcus Brown, the architect of this phantom empire, makes one final desperate gamble to maintain the illusion. He tasks Marsalek with producing authentic-looking bank confirmations for the trust accounts in the Philippines and Singapore. What follows is a masterclass in document forgery and institutional deception. Marsalik's team creates fake emails from bank officials, forges balance confirmations on stolen letterhead, even fabricates entire email threads with bank compliance departments. They submit these documents to Ernst & Young, hoping the auditors will accept them as sufficient evidence and sign off on the 2019 financial statements. But EY's forensic team, finally alert to the possibility of systemic fraud, makes direct contact with the banks named in the confirmations. The responses are unambiguous. No such accounts exist. The confirmations are forgeries, and Wirecard has no business relationship with these institutions. In June 2020, Ernst & Young refuses to sign Wirecard's audit, publicly stating that 1.9 billion euros reported on the balance sheet probably doesn't exist. The announcement detonates across financial markets. Wirecard's stock price collapses by 85% in 2 days, as investors flee what they now recognize as one of the largest corporate frauds in European history. Braun appears on television, pale and hollow-eyed, insisting there must be some accounting error, some misunderstanding that can be resolved. But the performance is unconvincing. He looks like a man watching his carefully constructed reality disintegrate in real time. Within days of the audit failure, Jan Marsalek vanishes. On June 18, 2020, he boards a flight from Vienna, but never arrives at his declared destination. Flight records show him entering the Philippines briefly before disappearing completely from Western tracking systems. Intelligence analysts later pieced together his escape route. Private aircraft from Manila to Zhuhai, China, then overland through a network of safe houses to Moscow. Marsalek has successfully executed his exit strategy, vanishing into the protection of Russian intelligence services, who apparently valued his connections and information enough to grant him sanctuary. He remains a fugitive, wanted by Interpol, living somewhere in Russia under state protection. A corporate executive turned intelligence asset, turned international fugitive. Braun, lacking Marsalek's spy network and escape routes, is arrested in Munich on June 22, 2020. He maintains his innocence, claiming he too was deceived by subordinates, that the missing billions represent money stolen from Wirecard rather than money that never existed. The defense is pathetic. A CEO supposedly unaware that 2/3 of his company's cash holdings were fictional, that his most trusted lieutenant was running intelligence operations on the side, that the entire Asian business was an elaborate fraud. As prosecutors dig deeper into Wirecard's operations, the full scope of the conspiracy emerges like a mass grave being slowly excavated. The Phantom Empire operated through a meticulously constructed architecture of deception that spanned continents and corrupted institutions at every level. Wirecard created a network of shell companies in the Philippines, Singapore, Dubai, and Ireland, legal entities that existed on paper but conducted no actual business. These shells would process payments from merchants who themselves were often fictitious, generating transaction records that looked legitimate when viewed from Europe, but dissolved into vapor when investigated locally. Money would be transferred between these entities in complex circular patterns, paid from a Wirecard entity to a third-party processor, then back to another Wirecard subsidiary, creating the appearance of revenue and cash flow where none existed. The scheme required constant maintenance, new forged documents to explain old inconsistencies, fresh shell companies to replace ones that attracted scrutiny, increasingly elaborate lies to auditors who asked increasingly uncomfortable questions. Braun and Marsalek recruited accomplices in the financial industry, lawyers who established shell companies without asking what they'd be used for, accountants who prepared fake financial statements, bankers who opened accounts for entities they knew were fraudulent. Some accomplices were knowing participants in the fraud, paid handsomely for their cooperation and silence. Others were useful idiots, professionals who should have questioned the transactions they facilitated, but chose willful ignorance over awkward inquiries. The network even included individuals connected to intelligence services in multiple countries, figures who could provide diplomatic cover, facilitate document forgery, and open doors in jurisdictions where questions might otherwise be asked. Wirecard became a vehicle for much more than accounting fraud. It was a money laundering infrastructure, an intelligence operation, and a mechanism for corrupting regulatory oversight. But the most chilling aspect of the Wirecard scandal isn't the fraud itself. It's how many institutions failed to stop it, how many gatekeepers chose not to see what was happening in plain sight. Ernst & Young audited Wirecard's financial statements for over a decade, signing off on accounts that were systematically fraudulent. The audit firm collected millions in fees while failing to detect, or perhaps choosing not to detect, that 2/3 of their clients' reported cash didn't exist. When whistleblowers approached EY with evidence of fraud as early as 2008, the firm dismissed the allegations and continued certifying Wirecard's accounts without serious investigation. BaFin, Germany's financial regulator, not only failed to investigate Wirecard properly, but actively attacked the journalists who exposed the fraud, filing criminal complaints and imposing short-selling bans to protect the company's stock price. The regulator had multiple warnings over the years: whistleblower reports, suspicious transaction patterns, allegations from former employees, but consistently sided with Wirecard against its accusers. Some analysts suspect deeper corruption: personal relationships between BaFin officials and Wirecard executives, political pressure to protect a German technology champion, perhaps even financial incentives that aligned the regulator's interests with the fraudsters. Deutsche Bank, Commerzbank, and other prestigious financial institutions extended billions in credit to Wirecard, accepting the company's financial statements at face value despite red flags that should have triggered due diligence. Investment funds, pension managers, and institutional investors poured money into Wirecard stock, either ignoring the Financial Times investigations or dismissing them as market manipulation. Even after KPMG's 2019 audit raised serious concerns, most institutional investors maintained their positions, unwilling to accept that a DAX 30 company could be fundamentally fraudulent. The scandal reveals a systemic failure of corporate governance, regulatory oversight, and financial journalism. A collective choice to believe a comforting lie rather than confront an uncomfortable truth. As Wirecard collapsed into insolvency in June 2020, the human cost became brutally clear. Institutional investors lost over 20 billion euros as the stock became worthless. Pension funds that had invested in Wirecard as a safe, regulated German blue-chip company saw their holdings evaporate overnight. Retail investors who believed in the fintech dream lost their life savings. Retirement accounts decimated by fraud they had no way to detect. Wirecard's actual payment processing business, the legitimate operation serving real merchants, was sold off in bankruptcy, leaving thousands of employees jobless and merchants scrambling to find alternative payment providers. The scandal metastasized into a political crisis that reached the highest levels of German government. Chancellor Angela Merkel had personally lobbied Chinese officials on Wirecard's behalf during a state visit, asking them to grant the company licenses to expand in China. Finance Minister Olaf Scholz faced parliamentary inquiries about why his ministry hadn't acted on warnings about Wirecard, why BaFin had attacked journalists instead of investigating the company. Documents emerged showing German intelligence services had assessed Wirecard as a potential asset for industrial espionage, seeing its payment processing technology as a way to gather economic intelligence from transaction data. The scandal wasn't just corporate fraud, it was institutional corruption at the intersection of business, government, and intelligence services. The trials began in December 2022, with Marcus Braun facing charges of fraud, market manipulation, and embezzlement. The prosecution presented a devastating case built on forensic accounting, whistleblower testimony, and communications recovered from Wirecard's servers. Email threads showed Braun personally directing the creation of fake accounting documents, approving payments to shell companies, and orchestrating the response to auditor inquiries with fabricated explanations. His defense, that he was deceived by Marsalek and others, crumbled under cross-examination. Evidence showed Braun attending meetings where the fraudulent structure of the Asian business was explicitly discussed, reviewing financial models that only worked if the third-party revenues were fake, personally signing documents he knew contained false information. In March 2024, he was convicted on all major charges and sentenced to 14 years in prison, though the sentence felt inadequate given the scale of destruction his fraud had caused. Other members of Wirecard's executive team who hadn't fled received sentences ranging from probation to 11 years, their careers and reputations destroyed by their participation in the fraud. Jan Marsalek remains in Russia, beyond the reach of European law enforcement, occasionally surfacing in intelligence reports as a consultant to Russian businesses with Kremlin connections. He lives comfortably in Moscow, protected by a state that values his knowledge of European financial systems and his willingness to share it. Interpol has issued a red notice, but no serious attempt at extradition has materialized. Russia doesn't extradite its protected assets, especially those useful to its intelligence services. Marsalek's story represents the ultimate escape from accountability, a criminal who successfully transformed himself into an intelligence asset valuable enough to grant permanent sanctuary. The institutional reckoning has been slower and less satisfying than the criminal prosecutions. Ernst & Young paid €11.7 million to settle regulatory charges in Germany, but admitted no wrongdoing, and continues to operate as one of the world's largest audit firms. The firm faced no criminal charges, no disbarment, no fundamental consequences for a decade of audit failures that enabled massive fraud. Some individual EY auditors were fined or suspended, sacrificial offerings to public anger, while the institution itself survived intact. BaFin underwent reorganization and promised reform, but the officials who attacked journalists and protected Wirecard faced minimal consequences, some resignations, some early retirements, but no criminal liability for regulatory corruption. The banks that extended billions in credit to Wirecard, based on fraudulent financial statements, wrote off their losses and moved on, treating the scandal as an unfortunate error in judgment rather than a failure of due diligence. Only the investors bore the full cost of the fraud. Billions in losses that couldn't be recovered, retirement savings that evaporated, financial security destroyed by lies they had no way to detect. The asymmetry is striking. Individuals went to prison while institutions paid fines. Executives faced criminal trials, while audit firms and regulators issued apologies and promised to do better. The scandal exposed a fundamental truth about modern financial systems. Fraud on a large enough scale, committed by institutions important enough to the economy, triggers a protective instinct from the establishment rather than accountability. Too big to fail has a corollary, too important to prosecute fully. For those seeking lessons in this wreckage, Wirecard offers several dark truths about wealth, power, and the machinery of deception. First, the lesson of institutional capture. Regulators meant to police corporate behavior, instead became protectors of the very fraud they should have stopped, their judgment corrupted by proximity to power and political pressure to support a national champion. Second, the lesson of willful blindness. Auditors, banks, and investors ignored obvious warning signs because acknowledging the fraud would have threatened their own interests, creating a conspiracy of self-interested ignorance. Third, the lesson of complexity as camouflage. Wirecard's fraud succeeded because it was hidden behind layers of corporate structure, offshore entities, and cross-border transactions that made verification difficult and discouraged inquiry. Fourth, the lesson of narrative over substance. The company's stock soared not because its business model was sound, but because it told a compelling story. European fintech champion, digital payments revolution, technology innovator, that investors wanted to believe. Fifth, the lesson of corrupted gatekeepers. The institutions meant to protect market integrity, auditors, regulators, financial journalists, either failed in their duties or were actively co-opted by the fraud, leaving investors defenseless. And finally, the lesson of asymmetric accountability. The executives who committed fraud faced prison, but the institutions that enabled it, the audit firms, the banks, the regulators, survived with their power and profitability largely intact, teaching a cynical lesson about where consequences fall in modern capitalism. Today, Wirecard's former headquarters in Munich stands as a monument to corporate fraud. The building occupied by new tenants, the signage removed, the company itself dissolved into bankruptcy. The legitimate payment processing business was sold to Santander, stripped of the Wirecard name and fraud-tainted reputation. Thousands of former employees scattered to new jobs, some having been complicit in the fraud, others genuinely unaware they worked for a criminal enterprise disguised as a fintech company. The broader impact on Germany's financial reputation was profound. The scandal exposed weaknesses in German corporate governance, revealed corruption in German financial regulation, and shattered the narrative of German business as synonymous with engineering precision and institutional integrity. International investors who had viewed the DAX as a safe, well-regulated market now approached German companies with heightened skepticism, demanding more rigorous due diligence and independent verification. The scandal triggered regulatory reforms, strengthened audit requirements, mandatory rotation of audit firms, enhanced oversight of financial services companies, restrictions on short-selling bans that could protect fraudulent companies. But skeptics note these reforms are procedural rather than cultural. They create new rules without addressing the deeper rot of institutional corruption and willful blindness that allowed Wirecard to flourish for 2 decades. The real question isn't whether the specific loopholes Wirecard exploited have been closed, but whether the incentive structures that rewarded fraud and punished whistleblowers have fundamentally changed. The evidence suggests they haven't. Corporate fraud remains profitable when successful and survivable when caught, especially for institutions important enough to the financial system. In the end, Wirecard's story is a dark parable about the nature of modern financial fraud and the institutions that enable it. The company succeeded not because Marcus Braun was a criminal genius, but because the system was designed to let fraud of sufficient sophistication and scale succeed. Auditors who profit from long relationships with clients lack incentive to detect fraud that would destroy those relationships. Regulators who measure success by the health of the companies they oversee face political pressure not to discover problems that would embarrass their government. Journalists who expose corporate fraud face legal threats, regulatory investigations, and accusations of market manipulation from the very institutions meant to protect market integrity. Investors who raise concerns about suspicious accounting get dismissed as short sellers with ulterior motives rather than whistleblowers performing a market service. The scandal revealed how easily the machinery of capitalism can be corrupted when the gatekeepers meant to maintain its integrity instead become accomplices to its deception. Wirecard's phantom empire existed because everyone with the power to end it had reasons not to look too closely. Audit fees to collect, political reputations to protect, investment returns to maintain, comfortable relationships to preserve. The fraud succeeded because failure would have been inconvenient for people who mattered more than the victims, who would eventually pay the price. This is the dark machinery of institutional corruption. Not dramatic conspiracies, but quiet choices to ignore warning signs, dismiss uncomfortable evidence, and protect established interests at the expense of market integrity and investor protection. The €2 billion that never existed weren't just numbers on a balance sheet. They represented a collective delusion, a shared agreement among powerful institutions to believe in something everyone should have known was impossible. Wirecard's greatest trick wasn't the accounting fraud itself, but the social engineering that convinced auditors, regulators, investors, and politicians that the fraud was reality. The company built its phantom empire not in offshore tax havens or through complex derivatives, but in the space between what people chose to see and what they chose to ignore. Somewhere in Moscow, Jan Marsalek lives comfortably on money stolen from European investors, protected by a government that values his knowledge and his secrets. In a German prison, Markus Braun serves his sentence, still maintaining the delusion that he was deceived rather than the deceiver, unable to accept responsibility for the destruction his fraud caused. The institutional enablers, Ernst and Young, BaFin, the banks, the politicians, issued apologies and implemented reforms while avoiding the fundamental reckoning their failure demanded. And the victims, the ordinary investors who trusted that a DAX 30 company, regulated by German authorities and audited by a prestigious firm, must be legitimate, absorbed losses they'll never recover. This is the final lesson of Wirecard. In modern financial systems, the cost of fraud falls on those least able to prevent it, while those with the power to stop it face consequences measured in reputational damage and regulatory fines rather than criminal accountability. The phantom empire has fallen, but the machinery that allowed it to exist remains intact, waiting for the next fraud, sophisticated enough and important enough to warrant protection rather than prosecution. And somewhere in the shadows of global finance, the next Wirecard is already being built. Subscribe and listen to our next story below.